Something historic is happening quietly behind the scenes of global finance. Nations around the world, from China to Japan, Saudi Arabia to Brazil, are selling off U.S. treasuries, the very debt instruments that have long been considered the backbone of the global financial system. But why? Why would countries willingly give up the asset that defined decades of stability? The answer lies in debt, geopolitics, and a slow erosion of trust in America's economic leadership. A U.S. Treasury is simple in concept. When the government spends more than it collects in taxes, it borrows the difference by issuing bonds. Investors, banks, and foreign nations buy them, essentially lending money to the U.S. government for a promised return. For decades, it worked perfectly. But now, cracks are forming. The U.S. national debt has ballooned to unprecedented levels. Trillions in new borrowing have been added in just a few years. Investors are asking the same question: can this continue? China, once the largest holder of U.S. debt, has been steadily reducing its holdings. Japan has done the same. And the reasons go beyond economics, they're strategic. When the U.S. weaponizes its financial system through sanctions, holding too many treasuries becomes risky. Inflation adds another layer. Returns on treasuries are no longer guaranteed. If inflation is higher than bond yields, foreign holders lose purchasing power every year. It's like lending money to a neighbor who keeps printing their own currency. The value of your loan erodes before your eyes. And there's more. Alternative trade systems are emerging. BRICS nations, Gulf countries, and others are now conducting transactions in their own currencies, reducing reliance on the dollar. Slowly, the world is moving away from Washington's grip. The question is simple but terrifying. What happens to the U.S. and the world when confidence in the dollar and treasuries starts to crumble? The U.S. national debt isn't just a number on a balance sheet, it's a ticking time bomb. Trillions of dollars in new borrowing pile up every year. Interest payments alone now consume over $1 trillion annually, more than the entire defense budget. At first, it seems manageable. The Federal Reserve buys bonds. Investors continue lending, but this is not ordinary borrowing, it's a Ponzi-like cycle. Old debt is paid off with new debt. The more the government borrows, the higher the stakes. Foreign nations are watching carefully. China once held over $1.3 trillion in U.S. treasuries. Today, it's less than $770 billion. Japan, another major holder, is stepping back too. Why? Because reliance on U.S. debt is a strategic vulnerability. Imagine this. A country holds hundreds of billions in treasuries, but if conflict or sanctions occur, their assets could be frozen overnight. The question becomes not, how much can I earn? But, how safe is my wealth? Inflation makes the picture even worse. If bond yields are low but prices rise sharply, investors are effectively losing money. Their purchasing power diminishes year after year. It's a slow but relentless erosion, invisible until it's too late. And then comes the new wave of alternatives. Gold, digital currencies, and commodities are no longer niche investments, they're the new safe havens. Central banks across the world are quietly moving away from dollars, signaling the start of a profound shift in financial power. The debt trap isn't just a U.S. problem. It's a global warning. When the foundation of the financial system becomes fragile, everyone feels the tremors. The global financial stage is no longer just about numbers, it's about strategy, leverage, and power. For decades, the U.S. dollar was the unquestioned king, and treasuries were the safe anchor. But in recent years, nations have realized that holding too much U.S. debt comes with a hidden cost: vulnerability. When the U.S. freezes assets, imposes sanctions, or uses its financial system as a weapon, countries take note. Russia's frozen reserves in 2022 sent a shockwave around the world. Suddenly, wealth held in dollars was no longer fully under foreign control. China, Japan, and other nations responded cautiously. They diversified reserves, invested in gold, and explored alternative currencies. The message was clear: relying solely on the dollar is risky. This isn't just about economics, it's politics. The dollar became a tool of influence, but overuse can backfire. As nations sought to protect themselves, they also began to rethink global alliances and trade practices. Oil was traded in yuan, not dollars. Cross-border settlements bypassed New York and Washington. Even strategic investments changed. Countries acquired infrastructure, industrial capacity, and technology, assets that could maintain value even if the dollar faltered. The era of passive savings was over. Active, strategic financial planning became essential. Citizens felt ripples too. Mortgage rates, loan costs, and everyday prices began to reflect global uncertainty. The consequences of these geopolitical shifts were no longer abstract, they hit local economies, businesses, and personal finances. The world was entering a new era of multipolar finance, where power depended not just on size, but on adaptability, foresight, and trust. And in this environment, every move mattered. A single misstep could trigger cascading effects across continents. As confidence in the dollar and treasuries began to waver, nations and investors sought new anchors of stability. Gold, long seen as a relic of the past, surged back into the spotlight. Central banks bought gold at rates unseen in decades. Unlike paper money, gold could not be printed, frozen, or devalued. Its value was universal and timeless. But gold alone was not enough. The digital revolution had arrived. Governments launched central bank digital currencies, CBDCs, while private cryptocurrencies grew legitimate. Cross-border payments could bypass traditional banking systems. Ordinary citizens could now hold part of the global financial system in their pockets. Yet with this freedom came risks. Digital assets required vigilance. Hackers, rogue states, and cyber threats constantly tested vulnerabilities. Wealth was no longer just money, it had become information, influence, and control. Strategic investments also gained prominence. Real estate, infrastructure, commodities, and technology became critical. Nations diversified their holdings not just for profit, but for financial sovereignty. Saudi Arabia and Russia invested heavily in energy and metals, while Asian countries secured industrial supply chains. For ordinary citizens, this era demanded awareness. Savings in local banks or pensions were no longer guaranteed to hold value. Individuals had to diversify, educate themselves on digital assets, and anticipate global shifts. Knowledge became a financial shield, just as valuable as gold or crypto. Opportunities thrived amidst chaos. Those who adapted, leveraging gold, digital currencies, and strategic assets, could thrive even as the old system faltered. The world was multipolar, interconnected, and unforgiving. Survival depended on foresight and adaptability. The seismic shifts in global finance weren't just headlines for governments and corporations, they affected every household, every wallet, every life. Ordinary citizens suddenly faced challenges that were invisible to previous generations. How do you protect your savings? How do you survive when your local currency is losing value? How do you participate in a world where financial power is no longer centralized? The first step was knowledge. Citizens needed to understand global flows of money, inflation, and debt cycles. Ignorance was no longer bliss, it was risky. Those who tracked central bank policies, interest rate trends, and international developments gained a strategic advantage. Next came diversification. People no longer kept all their wealth in one bank, one currency, or one asset class. Gold, digital currencies, real estate, stocks, and commodities became part of a personal safety net. Those who spread their resources wisely were able to absorb shocks that would devastate others. Technology became a game changer. Digital wallets, blockchain, and online exchanges allowed individuals to participate directly in global finance. Money was no longer just physical, it became code, influence, and power at your fingertips. Community and cooperation also emerged as key survival strategies. Local trading networks, barter systems, and regional exchanges thrived. Ordinary citizens realized that resilience often came from collaboration, sharing resources, knowledge, and strategies to withstand global financial shocks. But adaptability was more than assets or technology, it was mindset. Observing trends, anticipating risks, and acting before crises hit became essential. Patience, awareness, and proactive decision-making were as valuable as any financial instrument. The lesson was clear. The future belonged not to those who relied blindly on old systems, but to those who understood, diversified, and acted decisively. In this new era, ordinary citizens could not only survive, they could prosper amid uncertainty. The financial world was changing, and the center of gravity was shifting east, south, and digitally. For decades, the US dollar dominated global trade, but now a new generation of rising powers was challenging that supremacy. China, India, Brazil, and other emerging economies were no longer just participants, they were strategic competitors. China had long relied on US debt as a byproduct of trade surpluses, but that era was ending. Beijing reduced its holdings, invested in gold, and expanded its digital currency infrastructure. India leveraged technology and trade partnerships to strengthen its position. Brazil, Russia, and South Africa, the BRICS nations, began creating parallel systems to settle trade outside the dollar-centric world. These moves weren't just economic, they were geopolitical statements. Nations realized that financial independence meant national security. Every bond sold, every alternative system built, was a step toward sovereignty over wealth. Meanwhile, smaller nations watched carefully, learning from the strategies of these rising powers. Some embraced local currencies for trade. Others diversified reserves with gold and commodities. Across continents, the message was clear: control your own financial destiny or risk dependency. But with opportunity came risk. Rapid changes in the global order created volatility. Currency swings, interest rate shocks, and unexpected crises became the norm. Those unprepared, whether nations, corporations, or individuals, faced sudden consequences. For investors and citizens, this era demanded constant vigilance. Understanding emerging powers, analyzing policies, and anticipating shifts were no longer optional. The world was moving faster than ever, and delay or inaction could be costly. Yet for those who observed, adapted, and acted, opportunities abounded. Rising powers created new trade routes, new digital platforms, and new investment horizons. The global economy was no longer dominated by a single superpower. It was multipolar, dynamic, and unpredictable. The global financial system was showing signs of stress unlike anything seen in decades. U.S. debt was soaring, yields were spiking, and the traditional safety net, the Federal Reserve and foreign buyers, was no longer fully reliable. The Treasury market, once the calm anchor of global finance, was now a ticking time bomb. Fewer foreign buyers, rising interest rates, and escalating deficits meant borrowing costs were climbing. Mortgages, loans, and corporate financing all began to feel the squeeze. Banks and hedge funds relied on treasuries as collateral. When prices fluctuated sharply, it wasn't just numbers on paper, it threatened real-world liquidity. Margin calls, forced selling, and ripple effects could spread across continents in hours. Meanwhile, inflation continued to chip away at returns. Long-term investors who bought bonds near zero yields were sitting on steep losses. For many central banks, reinvesting maturing bonds wasn't appealing, letting them roll off quietly became the strategy. The risk wasn't hypothetical. The repo market crisis in 2019 offered a glimpse of how quickly financial systems could seize. Panic spread in hours, requiring emergency intervention from the Fed. Today, with fewer buffers, the same scenario could be far more dangerous. And it wasn't just the US. Other nations faced pressures. Japan selling treasuries to defend the yen, emerging markets coping with currency volatility, and global supply chains disrupted by economic shocks. Every financial decision, from Beijing to Sao Paulo, was now part of a high-stakes global chess game. Yet amid this danger, opportunity existed. Those who understood the signals, tracking debt levels, interest rates, and currency flows, could position themselves strategically. Survival depended on insight, timing, and diversification. In the midst of financial chaos, technology emerged as both shield and weapon. Digital finance, blockchain, and innovative payment systems became lifelines for nations and citizens alike. Central bank digital currencies, CBDCs, allowed countries to control monetary flow directly, bypassing old intermediaries. Cryptocurrencies offered freedom from traditional banking systems, giving individuals and businesses the ability to store and transfer wealth securely, even across borders. Blockchain technology wasn't just about currency, it was about trust, transparency, and resilience. Contracts, trade settlements, and investments could now be executed in real time with minimal reliance on traditional financial institutions. For citizens, the lesson was clear: knowledge of digital finance was no longer optional. Understanding wallets, exchanges, and decentralized platforms became essential survival skills. Those who embraced innovation could protect savings, hedge against inflation, and even seize opportunities in a volatile market. Innovation extended beyond currency. Smart contracts, tokenized assets, and real-time analytics allowed both governments and individuals to react faster than ever before. Strategic assets, gold, real estate, commodities, could now be traded with unprecedented speed and efficiency. Yet this new digital frontier carried risks. Cyberattacks, hacking, and regulatory uncertainty meant vigilance was vital. For every opportunity, there was a potential pitfall waiting. Those unprepared could lose wealth as easily as they could gain it. The story was no longer just about debt or dollars, it was about adaptation, foresight, and mastery of new financial tools. The landscape had shifted, and only those who evolved alongside it could thrive. The world is on the brink of a new financial era. The dominance of the US dollar is being tested. Traditional treasuries are no longer the unquestioned safety net. Nations, corporations, and individuals are redefining what stability means. Emerging powers are rising, digital finance is expanding, and alternative assets like gold, commodities, and tokenized investments are reshaping global wealth. The game is no longer static, it's dynamic, interconnected, and fast-paced. For nations, this means creating resilience. Diversifying reserves, investing in technology, and building alternative trade networks are no longer optional, they are imperatives for survival. For citizens, it's about knowledge, strategy, and adaptability. Understanding how global finance works, diversifying assets, and leveraging digital tools can protect and even grow wealth in uncertain times. Those who wait passively may lose purchasing power. Those who act proactively can thrive. The rules have changed. Trust in one currency, one system, or one government can no longer be assumed. The new era rewards education, foresight, and decisive action. Now is the time to take control of your financial future. Study global trends, diversify your investments, explore digital finance, protect your wealth, because in a world of uncertainty, knowledge and preparation are your most valuable assets. The financial landscape is evolving. Will you adapt, survive, and thrive, or will you be left behind?